Hello and welcome to The Gray Report. I'm your host, Matt Bosnagel, filling in for Spencer Gray as the host and bringing in the ever-capable, the genius intellect of Sir Addison Lubert here in the Gray Report studios. And I think we've got a really great show today. We are covering an article by Moody's about the Survive Until 25, the extended pretend, the things and conditions and participants of this waiting game in commercial real estate. We're also going to be covering a Globe Street article and institutional investor article to that effect, talking about the debt that's happening in the office market, the multifamily market specifically, and the kinds of mechanisms and organizations and strategies that borrowers and lenders are using to meet the needs of a changed lending market for commercial real estate and really for businesses in general. From there, we'll go over a bunch of reports on the state of the multifamily market. So if you are a multifamily investor, if you are just interested in multifamily, or if you are an industry insider, we have something for all of you and each and every one of you, a piece of information that will be valuable, important, and will probably make you a little bit more successful in the coming years. This is not investment advice, but it is going to be a great show about the multifamily market, real estate, and the economy. This is the Gray Report. All right, welcome back to The Gray Report. This is Matt Bosnagel, and I'm bringing in to the studio today. We are fortunate to have Addison Lubert. He is, like I think I've alluded to, his genius intellect and really the wisdom of what I call wise beyond your years, like an old soul. Have you ever heard that before? Have you ever heard yourself described as an old soul?
No, I think you're just building up anticipation just so you don't, so people don't log off.
Yeah, that's right.
Not on this episode.
Well, that's fine. It will take a little different character. It may not be the exact same as Spencer, but we'll try to bring our own flair to it. I think that there's a chemistry and an atmosphere here that can't be replicated. It's always different, no matter who's the guest. But when you're here, I think that I think I get a little less controlled, but a little more nervous. Like I'm scared of what I might be capable of. So that's what happens when Spencer is not in the room. I do have a guide, though. I do have some notes, and there was some really great news that happened this week that we can talk about. So it's not always going to be like free form, throw whatever you've got at the wall. We do have some structure here, but I do have a question that I warned you about before, and I'm very curious about is, I'm thinking about, we're heading into the end of 2023. 2024 is right around the corner. Everything all year, everyone's talking about how people are waiting. I alluded to that when we were talking about what the CRE waiting game that's going on for borrowers and for lenders. And are they still waiting? Are we going to wait? Are we going to see more transactions when the year's closed for Q4 compared to Q3, Q2, or Q1? Or has there really been a slowdown? And do you really expect things to really be slow as December rolls on into?
So I don't officially know how it is. I think what comes to mind for me is a lot of deals are, when they say transactions, when they're done, they're listed as like when they're closed upon. And so you have a lot of people that are transacting on stuff, I'd say probably post July 4th. In a normal year, it seems that a lot of deal volume is done from post July 4th really till around Labor Day weekend. Afterwards, might see some stuff come onto market in October, but people are really closing on deals, doing the due diligence process, and they're trying to get it done before year's close. Mm-hmm. So I think you're already going to see a lot of Q4 stuff. You're going to see the stats filter that way just because that's when people close. Mm-hmm. So to say this year, I don't think it'll be the same in terms of that transaction situation because there at times seemed to be a more of a slowdown, at least from deals that I was seeing come across my desk on market. Mm-hmm. It seemed like there's definitely a slowdown in the March, April, May, June, July
Yeah.
timeframe.
Yeah.
But with that being said, there's also a lot of deals that have been on market that have come across my desk in the October, November, December timeframe where I'm not really used to seeing that in my limited experience. So with that long drawn out answer, no, I don't think you're going to see as much volume in quarter four, but I think it's going to be delayed because people are in Q4 seeing deals come across their desk. And so who knows? I don't know how long the process is going to go for a lot of folks.
Yeah.
I mean, we've been a part of deals that have taken from the time that we were in the PSA negotiation to when we closed on the deal have taken a really long time, multiple months, going across quarters. So for all we know, next year could be certainly a higher transaction volume in quarter one or into quarter two than normal.
Yeah.
But no, I wouldn't expect a pretty high Q4 here just because there wasn't at least to me, it didn't seem like there was as much activity going on.
Yeah. Like in the few months back when things should have started, you didn't see.
Right.
Yeah. No, that makes a lot of sense. It was either at or near. I'm talking about the 10-year Treasury was at or near 5%. A couple months ago, or maybe it seems that long. But it certainly doesn't seem like things can get started and finished in a month's time. Starting here from early December onto the end of the year. But maybe there's a motivated buyer. I did want to note that we have this. It's from CoStar. It is the sales volume and market price per unit. Now, I'm really more focused on the sales volume and really more as a relative number. I'm not sure if these are like perfect, especially the Q4 numbers is a projection and an estimate. And right now they have it at about half the volume, maybe a little less than Q3. So Q4 sales transactions were about half of Q3. Now, I wonder if things will get adjusted and we'll see a Q4 a little bit higher than Q3, but not dramatically so. And ultimately, I really wanted to get the numbers for the fourth quarter of multifamily sales, because I want to be able to look at this whole year and say, wow, it was about half as much sales activity as it would have been if it was a normal year. And I'm talking about like pre-pandemic, like if it was 2019, it's about half of the sales volume in 2023. So, going back 4 years pre-pandemic, that's what it would have been. And probably even less than half considering with, like inflation and all that kind of stuff. But I am digressing a little bit. I do kind of agree with you, or at least, from my perspective of, looking at these like research articles and reports and stuff, and less like specific on the ground experience like that you're into. It doesn't seem like I'm hearing a lot of sales. I'm hearing people really ready to jump in and acquire stuff. It is a waiting game, a lot on sellers that are trying to wait for more favorable a more favorable environment where they can sell for a higher price, and a lot for buyers that aren't willing to bite at such high interest rates too. So it's really depressing on both sides. Sad, but also lower.
Yeah.
The dual meaning of the word depressed. But that being said, and we noted this for the past couple of weeks, is it survive till 25. It's a great little rhyme, but it also reflects a very real conditions in that we are seeing better demand, or at least more healthy demand's not falling off a cliff for multifamily among multifamily renters, and it is this short-term supply shock that we're seeing that will play out as 2024 progresses, but it's a very finite thing, and it's never been more clear that like, okay, the sun is shining behind these clouds, but we just have to wait for them to pass. The reality of it, the kind of negative side would be to talk about maturities and the people that are facing more acute and pressing threats, the people that may not, even if they don't have a maturity approaching or that has already expired, some multifamily borrowers just may not have had the business plan to allow them to survive in a situation where rents aren't increasing at like maybe even like 5%. The flat rents is really hurting them. And another context that I noted as I wrote the newsletter last night was it's budget time, or it seems like at a great capital.
It is, yeah.
It is budget time, and a lot of companies are seeing their whole year of expenses and income, and they're really kind of taking a look at it, and they're taking stock of things. And I don't think that that's going to lead to a lot of like dramatic revelations, but it will bring some issues to the forefront, perhaps, that will nudge people in one direction or the other. It will probably remind people, oh man, these expenses are a lot, and we didn't have the rent growth that we had this year like we did in 2022. There's actually net, for the year, it was net. There was net positive rent growth at a decent amount. Now that second half, yes, it was declining, but there was enough rent growth in the first half of 2022 such that the expense growth that was incurred there due to inflation, that was buoyed up, supported, or at least allowed the balance sheet to even out a little bit by the rent growth that happened in 2022. Not so in 2023. There's expenses, but rent growth, the income side is hurting. It's either flat or in some cases, like in the Midwest, there's some Midwestern markets, Indianapolis being one of them, have like 2.5% rent growth, which is great compared to essentially zero. We'll see in the rent growths or in the rent reports that we have from those three, from Yardi, RealPage, and Apartment List, they all have. It's all about rent growth's about zero, and that's probably what we're going to be at for the year. So
as a renter, that's great news.
And that's the thing is like, it's funny how Apartment List frames it too, because I think they know that the investment companies and asset holders are reading their reports a little bit, so they kind of catch us like, well, renters are going to have an easy time now. It's bad on the return side, we ignore the fact that it makes it a lot easier for renters, and we are getting to a point in RealPage. I forget if it was RealPage or Apartment List that notes this. We're getting to a point where wage growth is outpacing rent growth so much that the previous jump in rent growth, that it's kind of evening out. It's making up for those previous jumps that we saw in 2021 and early 2022. Mm-hmm. So that's really good news. I think that also on the home buying side, the fact that the costs for home ownership are so much more than rent, that's got to contribute and lead some people to renting. I think it is. There's plenty of factors that would lead to greater demand, but supply is decades high or generational highs of new apartment supply. So that's what it's kind of contending with. And in partially, these this wage growth and all these kind of influences that would increase demand, all of these things, they're probably are largely what has helped the apartment industry avoid, a massive crisis due to oversupply in 2023. And probably, things will pick up in terms of like asset performances for apartments in 2024. But it's largely due to a lot of positive things that are going on in the background. It's just hard not to look at that flat or lower rent growth number and not be a little bit depressed.
It's never fun
for an investor, sorry, not for a renter.
For fun, but never wise to just talk about what you hear in the news over actual data. But even had the interest rates not dropped, I'm not entirely sure we would have seen over a meaningful amount of oversupply across the board. Mm-hmm. All the news coming out of cities like Los Angeles, New York, Chicago, there might be an increase in supply, but in plenty of these places, it's still nowhere near enough.
Yeah.
So yeah. And also I think, your smaller markets, I know we've seen a little bit in Bloomington where newer supply has caused us to kind of look at some projections differently, but I don't think, really any of that I don't think it has affected any big markets or nothing that comes to mind. And also I think, given where the rate increases, I think if we fast forward probably another 3 or 4 years, we'll see rent growth going up because of a huge lack of supply.
Well, yeah, and that is the story for this maybe second half of 2025 into 2026 is like, okay, the high rates now are going to mean less supply than going forward, 2 years from now or something. I do think that it is worth. I just wanted to remind people about the positive factors for rent growth and how much demand could really be sitting behind all of this, like the flatter numbers that you see, and just in sheer numbers, remind people about how much there was built in the apartment industry in the past year. I'm not sure that there was a year that in which we built more apartments that CoStar has listed here. I'm going to try and pull up real time some numbers behind the deliveries on CoStar. And now here I'm just scrolling right down here. I have it. Okay, so you can see that. And now, listeners, you'll have to suffer through my description here, but in Q2 and Q3 of 2023, we had 156,000 deliveries, just about, and 151 for Q3. Now, that number is higher than any other quarter on record here, dramatically so. The only one that comes close maybe was in Q3 of 2020 when there were 124, but it just goes steadily down from there. It is looking like a whole lot of apartments are coming online now. I'm going to see how far back it goes, and it's. Also,
that's largest since 2000. I mean,
yeah. I mean, see, in charts like this, it's like, well, naturally, population growth, you're going to see more deliveries because the number of people are increasing. But it was a big jump afterwards, and I think it's also, and now this may just be CoStar always has their projections kind of revert to the mean, but CoStar has almost as much or more dramatic as the run up in deliveries that we saw in 2023 is how steeply they drop off in the following years. Oh, I'm sorry. I didn't even have that window shared here. Now you can see the dramatic run up and drop off on the YouTube video. I think I described it pretty well though, right? Anyways, a lot built in 23. Some people say, and I talked about this a couple weeks ago, there are a few projections that have 2024 as even more apartments being built. I think one of them is Apartment List is projecting that, and we'll cover that in a second here, are projecting even more apartments built next year than this year. I tend to think that it's going to be slightly less in 24, and then it's just going to gradually decrease rather than drop off dramatically like it is in this CoStar chart.
I don't necessarily disagree. One thing that I guess I could see 2024 being different, or maybe having outperforming expectations. I don't know if this is more of just sort of a time bias of I started paying attention to it at a certain time, but it seems like the majority of people that are, when it comes to housing supply, especially apartment supply, it seems like more and more people are behind the backing of not only do we need to build more units, but it seems like there's an ever-growing push of like enough with these stupid zoning laws.
Yeah.
If an apartment complex can be supported, build it. And I could kind of see how, and I don't, by no means am I saying we're going to see a repeat of the high quarters that you showed in 23. But I could see that situation where as more public frustration and outcry for adequate housing supply continues, especially with regards to, I feel like now more than ever people are starting to know and understand that it's not some crazy factor behind the lack of supply other than what the financing situation is and some of these rather dumb zoning laws.
Yeah.
And as long as I think that public push is around and you have in certain cities, certain politicians running on it, that's how I could see the new construction situation staying bullish. But I don't necessarily disagree with your original point.
Yeah. It will be interesting. And I talked about this, I think this was last week, seeing how the builders are going to react to not just the different interest rates, but like when they see rent growth flat, they're not going to go into that market. They'll go into the markets where rent growth is up, and they're not going to build an apartment if it's not going to get filled up with people. They're taking on a lot of risk, and I wonder, they've got to be able to look 1.5, 2 years in the future, and I wonder how quickly they will adapt, or how they're speculating on the future of the apartment market, because and this is what I keep thinking about. I mentioned this in passing, and we learned about it in 2020, is the 10-year outlook when you're thinking about the apartment market. 10-year outlook for population growth is not as great as the 5-year outlook. 5-year outlook, very positive. But there's going to be some adjustment that is made unless population growth really kicks back up. The demographics are not in the favor of the apartment market on like a 10 and 20 year level. Now, all this is, the caveat is like, this is probably a marginal effect that we'll have, but it will be a continuous drag. And obviously it's a market by market situation when you're talking about, whether population is going to grow or not.
I don't necessarily think developers are going to look at any place that has stagnating or negative rent growth and not be interested. I think anyone that's experienced it, anyone that's done it enough, they've probably seen cycles where, okay, for whatever reason in Indianapolis during this period, there was negative rent growth. I think,
well, and they might look in 2 years and they say, well, yeah, I know it's flat now, but if you look at job growth and economic growth in the area, then it makes sense to buy. Like, it's not just rent growth that's a factor, but I am very curious about what kind of decisions are going to be made, 5 years down the line, how they may be affected by supply, by population growth, by all these trends that are still up in the air.
I think more of it's going to have to do with more so land costs and construction.
Oh, interesting. Okay.
I
think that's probably true. And like I said, like population growth, it is so, it's variable by market, and it's less of it's a tiny change. Whereas we're talking about like, well, the cost of land could really go up and down, and really make or break, rather than like a slow tick up and point something of a % of population growth.
Mm-hmm.
Yep. All right, let's move on to the actual meat of this report, which is, sometimes we talk about news articles. I think I was referencing him, but I have a specific one listed here. It comes from Moody's, and it is timing out the CRE waiting game. The quote here that I'm going to use to enter into this is, "Everyone's eyes are turned to the Fed as the market awaits their next move." That's where we are right now. The quote's done. That's where we are right now. And that's where I'm saying that. Awaits is the big word here. Not a big action or movement either way by anyone yet. They're just waiting it out. I feel like there's a lot of nervous energy behind that waiting. I feel like people are waiting when they'd rather not be waiting. But like, they are making this conscious decision to not take action, and maybe it's not make payments. I don't know if we're talking about loan maturities, but they're looking if they could just hang on. Now, the larger context that Moody's does get into here is that there's not a really horrible outlook when it comes to the economy now. There's still a chance of recession, but in 2023, looking back, the economy's been marked by gradual growth and ebbing inflation, stable employment numbers, and, well, persistently low consumer sentiment. This consumer sentiment thing is something that I've been hearing about a lot in other places, particularly like there's like economists that are looking at how consumer, the economy is doing great and people are spending. So why do they feel so bad? And I think that a lot of it can be explained by inflation. I think inflation has a particularly so what we're looking at here, I have a chart here with a red line that shows inflation, with a blue line that shows consumer sentiment, and with a green line that shows consumer spending. Right now, inflation is it's coming down, but it's coming down very gradually, and the green line for consumer spending is higher in a relative fashion than the blue line for consumer sentiment. What I was getting at though is people don't understand why people feel bad. I think it's because of inflation. I think it is. I think that there is a level at which inflation gets high enough, and it's around the 3 or 4% range, where we see this intersection where that's where, if you're heading on, if inflation is going up from 3 to 4, well, that's when consumer sentiment starts to really go down. When it's going down, when it's going back from 4 to 3, which it currently is, then consumer sentiment starts to pop back up. Now, other places where consumer sentiment goes down, well, yeah, during recessions, but it is worth noting here that consumer sentiment is gradually heading, in the short term, it's heading down, but it is gradually heading up since it was at its low point in June 2022, precisely when inflation was at its high point. So this is a time outside of a recession when the real mover of this bad feeling about the economy was the fact that things are expensive. And I also think that there's a perfectly good reason why people are spending more and feeling bad about it. I thought that was like this traditional scenario of like runaway inflation, or of like the mindset of inflation is you buy and pay for the potato chips now because it's going to cost $1 more tomorrow. So that's why they're spending, is maybe the expectation of inflation is driving more immediate spending. Now, again, that's like it's more of a thought experiment than anything else, such as say it's like, there is a reason why people wouldn't feel great about the economy. I'm not saying that it is probably lower than it should be, but it's not without actual reason.
I guess I would understand more of this if we were having this conversation in December of 2022 than we are now.
Yeah.
I'd be curious to know, for people, where does almost the acceptance of inflation or the acceptance of higher prices, where that settles in.
Mm-hmm.
And I don't know if it's just particular to me and not paying attention enough. I don't know what it is, but I can't really say that there's anything that I've looked at in terms of pricing wise, be it, food, groceries, or whatever,
mm-hmm.
where I can say, this is just ridiculous now with inflation. I mean, I know gas prices have gone up, but at the same time, where gas prices are now, I feel like they've been that way before.
No, they have. I'll answer. Yeah, they have.
So there's a lot of that. What I'm curious to know is, how long does inflation or higher pricing
mm-hmm.
need to be in
the sub 3 level, kind of, before it fades away in people's psyche?
Well, like you're talking about expenses and people doing budgets.
Mm-hmm.
At what point how many years in a row do people need to see payroll hit a certain number post-pandemic, where people start to say, you know what, you really can't run payroll at a property anymore for $1,400? Mm-hmm. Instead of being annoyed by it, instead of trying to cut it in any means possible, they just realize that's what it is to staff an apartment right now.
Mm-hmm.
I wonder how long that really takes for that to hit consumer sentiment of, okay, this is just resetting where prices are.
Yeah.
I also think a lot of it has to do with, quite frankly, where you're getting your news and what you're willing to buy as the reasons for inflation.
Yeah.
Because I think there's plenty of things that cause inflation this time around that, I mean, there's you and I have talked about it multiple times
mm-hmm.
where I've been on there. There's plenty of factors that are around in this situation that are there's plenty more than just government spending.
Yeah.
And
yeah.
I mean, I don't know.
Mm-hmm.
I think you and I have both seen the reports that's circulated and filtered through the economy.
Yeah. Yeah.
And so I guess I'm wondering, what is
I think I know what it is.
Where do some of those frustrations come through?
I think I have some of it figured out. I think that people are mad about inflation, and now that inflation is more or less, it's at a more reasonable level. It's not crazy anymore, but it's still inflation. Prices are still going up. People are mad because prices aren't going back down. The only way to make people not feel better, or the only way to make people feel better, is if you make prices go down. We want deflation, not just lower inflation. People don't. People don't want inflation to go away. People want prices to go down.
Right. Yeah, I totally get that. I wonder at what point do things start to filter through of, all right, this is just what it is.
Yeah.
Because likewise, this is where we get into talking about anecdotes as opposed to evidence.
Mm-hmm.
Last summer, I felt like we were hearing a lot more of people that were saying like, yeah, we were going to go on a summer vacation, but it's just not feasible, or some form of cutting back. This summer and into 2023, in terms of that type of consumer spending or just different lifestyle things, I felt like I didn't see or hear as much about it.
Yeah.
And that's where I'm very much miffed on consumer sentiment, is I'm not really hearing people say that I'm still hearing people say groceries are expensive, or I'm still hearing people say that certain things are expensive.
Mm-hmm.
But I don't hear people saying, they're cutting back. And I'm sure in the comment section or whatever, someone's going to talk about how out of touch that is or sounds.
I
can understand that. I don't know. I don't.
No, I think that it is interesting. I think there's a lag period probably between how much inflation comes up and then people kind of get adjusted and they kind of anchor their prices at a new point. I think that it's probably a matter of years rather than months. And I also think that it is hitting different income levels differently. I even noted on the Gray report that lower income levels are feeling this more. They have a lower sentiment because probably more percentage of their income is taken up by food and gas, relative, to people with more money. But even that being said, the power of inflation to shape people's consumer sentiment, it's worth noting how low on an absolute level consumer sentiment is compared to the Great Recession. It's still like right now consumer sentiment is about the average of what it was during the previous, or during like from 2008 to late 2009. Those 2 years, we're about where we were during then, and it feels like things are going a little bit better than they were.
Right. But that looks like, if you go over to the low point there, all the way.
It's definitely
No, to the right of the screen.
Mm-hmm. This was the June 2022. It was
so right in 2022. It's looking like that's, unless I'm completely reading this wrong, aren't they? Is that saying it's the worst they've recorded?
Yes. At least as is graphed on this, now let me expand this information. This is coming from the University of Michigan, and they have information now that's shown on the Fred website. So this is University of...
That's the worst they've recorded since 1980. But that's wild that it was worse.
It is worse than 1980. So it is the worst that they've... And you can see that it's actually the graphs here, but it's not showing up on the screen. Suffice to say, I don't think that it gets any worse. It may have been the worst consumer sentiment on record. I'll have to look that up, but we are generally and this is where I want to say, like, I think that there is a space to be a little bit more hopeful, for that people are getting generally more hopeful. I think we're on a bumpy road upward for consumer sentiment. We are on a gradual road downward for inflation. And I think that we could also see some gradual decreases of interest rates. Not as dramatic as some might say, but I think that we're on the road for that. So that's a little bit of what Moody's says. And they also note to get into, so beyond the kind of larger macroeconomic picture that they provided, they talk about specifics, CRE particulars is what they call them, and the office market is one of them that is at facing particular amount of challenges.
Really?
And as much as people were talking about the return to the office and all this movement from people, like it's not happening as as strongly as was anticipated. People are, I don't want to say digging in their heels, but they're staying home if they can.
Yeah.
And there was a chart that I put in the last night's, this morning's really newsletter. If you're subscribed to the Gray Capital newsletter, then you would have received this for free in your inbox every Thursday morning. And if you're not subscribed, go to graycapitalllc.com/newsletter to subscribe to our free weekly newsletter, where it has all of these great charts and great pieces of information that I'm about to talk about right now. And one of them is a chart. You know what?
That's quite the plug there.
I know. I thought it was pretty good. One of them is a chart that shows how decades, maybe even a half a century of a work from home progress was achieved in the snap of fingers. Right when the pandemic hit, work from home just exploded, and it's come down to about half the level that it used to be, maybe. But it's still so much. There are so many more people working from home than there used to be. And it would have taken, if we followed that general trend of work from home that was steadily increasing every year, if we followed that out, it would maybe be at 2050 to reach the level that we arrived at because of the pandemic. My larger point was, people did return to the office, according to the chart that you can see if you are a subscriber of the newsletter. Or you can go to graycapital.com and search the Gray Capital blog, and that's available right now. And I'm going to go. This is on the fly. This is the kind of unstructured, freewheeling experience that Addison really evokes. And I apologize to those that may have less patience with these wild flights of fancy, but I promise you that the payoff's really great.
I really think the listeners of this podcast are going to enjoy you pulling up the website right now.
I know, that's why I'm doing it, and it's well worth it because the visual aid that it provides is very useful, and they say a picture's worth, I don't know how many, I forget how many words it's worth, but
it's not worth much to listeners.
But that's true. So listeners, skip ahead just a minute. I just want to show this to the viewers, and we'll get into it now. All right. So
probably had a lot of listeners log off when they heard someone's filling in for Spencer.
Yeah. Well, that's fine. Okay. So you can see here, it jumped from, so the pre-pandemic was about a trend of this 8% share of full paid days work from home. It jumped up to 61.5 when the pandemic started, this kind of lockdown period. And now we are at the relatively low 30.9. But what we're seeing here is not a whole lot of lasting back to work trend. Really, we should be at, work from home should be less than a third of what it is if we were if this was a normal pre-pandemic trends, but it has persisted and it is likely to remain persistent. That was my that's my argument in the nutshell, and a quick advertisement for the blog and for the newsletter. Anyways, so continuing back to
podcasting.
Yeah, back to podcasting. So yes, Moody notes those conditions in the office market, and also and moves on to talk about how retail is actually doing okay, not perfect, but it is showing some progress. And I think the phrase was, everyone was kind of waiting for the other shoe to drop, and the other shoe didn't drop for retail. It's doing okay. It's surviving maybe a lot more than multifamily, which it does single out. And Moody saw the dip in multifamily performance really as much as any eagle-eyed viewer or listener of the Gray Report. But really, you don't have to notice. You don't have to have perfect vision to notice that we had flat rent growth for apartments in 2023. And ultimately, Moody's predicts this performance to only start picking up in the later months of 2024 and into 25. That makes sense to me, and that's kind of what we've talked about earlier in this episode. I do have this paragraph here where I wanted to note, because I think that this is a phrase that we will continue to hear throughout next year. The quote is, "Here's where the waiting game theme comes in. We've begun to hear the quote, survive till 25 mantra, more and more. Potential sellers are waiting to make a move. Potential refi borrowers are waiting for rate declines. Borrowers with maturing loans are asking for extensions, and lenders are offering workouts for more favorable markets. That's it. It really, in a nutshell, we are in a strange period of intersecting sentiments and uncertainty, and we may be on the edge of a more favorable environment around the corner. And I don't think that and that's why I wondered if people don't want to close, because if they wait a little bit longer, maybe things are going to be a whole lot better for them. And it is frustrating because it seems like already December is like, well, everything's baked in for the multifamily market. You can't really do anything new. You just have to wait for the big NMHC conference in January to make any multifamily decisions. And I was secretly hoping that some really exciting stuff it was going to pop up, but it doesn't look like it's going to be that much of a disruption. So I think that's essentially where we're at. It may be repeating a lot of the reporting on this waiting game, but it was a worthwhile reminder of how much things have kind of changed, and how much room I think there is for a little bit more optimism. And I forget if it was. Now I need to look here, because Moody's made this prediction. Oh yeah, this is my favorite part. In the Moody's piece, it talked about the Fed should be able to pull back a bit in mid-2024, flatlining around 2.5% for the Fed funds rate. I don't think it's going to come down that quickly. I think maybe it could approach 3% by the end of the year, but really, I think that would be a pretty aggressive trajectory for the Fed to go from. Right now we're at 5 for the Fed funds rate. If we cut that in half in a single year's time, the only way I feel like that would happen is if there is a recession. So I don't think that borrowers and lenders really, they may have longer to wait than would be indicated by Moody's here. However, they may see that 2.5 as happening like maybe around December more than July. I just don't see interest rates improving because there's consumer spending, and there is so much activity in the economy that may be supercharged if they start that a series of regular rate cuts.
I don't disagree with you in the sense that I don't think we're going to see rate cuts.
It's a soft landing.
Quite frankly, I don't think we're going to see rate cuts. Period. Next year.
Really?
I think it'll be.
And I'm holding this plane, and I want to show you how if the rates slowly glide down, not get cut in half in a year, that's the soft landing. If you're going from 5 to 2%, I feel like that would be a rough landing. Now, for the listeners here, I'm holding the SR71 Blackbird model, and I'm simulating a soft landing, which is brought about by a gradual descent, not a sharp descent. This is a very expensive aircraft. I don't think that people are going to damage the economy by landing it too quickly. Is that enough of a mixed metaphor?
Sure.
That guy put a spell on you, Addison. That's really great. It was a good visual aid.
I guess where I'm kind of curious to know where the Fed goes is we continue to see a lot of wage growth that we really have not seen in quite some time.
Yeah.
And I'm wondering if the Fed at any point, what would have to happen for the Fed to realize, all right, like the wage growth is catching up. Some people that were hopefully, or that we were hoping to have had priced out during this interest rate hike haven't. They're showing some strong resiliency. Inflation's coming down. I wonder when that sets in. I really do, but I don't. I guess I can wrap my head and go back on my original comment. I guess I can wrap my head around dropping interest rates a little bit, but no, that's a pretty aggressive drop. That I would be stunned if that happened. Yeah, it'd be great for us, but
back to kind of from the perspective of multifamily borrowers and people looking to buy even. that's great. It would be amazing to go back to those wonderful years. But it's not going to happen quickly.
I don't know. I am wondering for the people on floating rate debt that are hurting right now, if that much of a drop keeps them back in this, like, if they're firmly in the, okay, we can hold on mode. Because I would imagine the high interest rates are hurting them a hell of a lot more than just a flattening of rent growth. Yeah. But I'm wondering if that much of a fall would help people enough to hang on to deals, or if that's still high enough that they need to part ways with.
No, that's good. And I think that has particular relevance for this next article from Globe Street, which is Multifamily Maturities Weaken While Office Improves. They're reporting that loan payoffs for apartment borrowers went down even as office payouts improved slightly. We've covered the wall of multifamily loan maturities on the Gray Report. We even discussed when we covered it, like, it's not going to be, things aren't going to be like burning down. There's not going to be huge, there's not going to be huge levels of crisis, but there will be maybe gradual, pockets of opportunity and distress caused by this increase in loan maturities. However, this report seems to imply that there is going to be a more measurable material effect from these maturities, maybe more so than we had anticipated. So I'm trying to figure out the numbers here. It says the quote is, although for most of the year the rate had easily topped 90%, this is the payoffs rate for multifamily properties. In September, it fell to 71.7. October brought it further down to 48.8%. Not only did more than half the loans in October fail to pay off, the October maturity defaults of $303 million make up over half of the $600.3 million of loans that have failed to pay off all year. So half of the loans that have failed to pay off come from this October. Do you know? I don't know if you know, but we did a research report that illustrated this very thing, and we did some updates throughout the year. We've been following this topic of loan maturities, and October's when it was supposed to hit. We said, look at October and November, and lo and behold, it's here. And it looks like it looks like there's $300 million worth of evidence that some people are hurting, and it's having a more dramatic effect. Because I thought that 99% of these borrowers would be able to talk to the banks and say, just listen, just give me a couple more months, I'll figure things out. But to have this, but to see it so dramatically in the month that they were due, is surprising to me. I felt like, and I do not know all the ins and outs and all the rules that, and how strict things are and how things work in this way. But I felt like if I was a borrower and I was doing okay, that I could go to the bank and bank, I get it. I'd rather you be able to pay me, period, than not pay me at all. So I'm going to give you an extension.
I mean, I'm sure that is the case, but they can't do that for everybody.
Yeah. And that may illustrate the size of the problem. Maybe that 99% or however, maybe the vast majority are getting extensions, but the problem's so big that it has cut that payoffs are about half as what they should be. Really interesting. And it is also interesting to think about how these maturities are going to be resolved in terms of like how are they going to get the money to get the loans? Are they looking for more capital? Are they going to put them for sale? And I think we're in this phase, I've mentioned it before, of figuring out what to do with this debt, of a non-bank lending, of working it out with the banks, of figuring out how to get, I don't want to say like short-term capital, but definitely like Band-Aid money solutions, but so that people can survive till 2025.
Well, I mean, there's a lot of stuff that's going to happen. You're going to see some defaults, and I would imagine you're going to have some lenders that, probably put the clamps on them and just say, there's only so much we can do on a workout, or we have so many people in the portfolio at the same position that no, we're not going to give you a workout. So those are two situations there. The other being that you're right. I think there are going to be, I shouldn't say I think, there are going to be people that need to do rescue capital, not necessarily in the sense that they're in distress, but their plan was they had a bridge loan or some short-term debt that they were going to have to do a refinance on. And there's going to be a gap of where they needed to get a refinance amount versus where things are actually coming out. If it's a small enough gap, they're going to go the pref equity route. They're going to do something, or if they feel like
pref equity is in the non-bank lending. Is that kind of in that larger category of non-bank lending, or is it adjacent?
I would say a little bit of both.
Yeah,
it really depends on where your source is coming from.
Yeah,
but they're going to do that, or if they feel comfortable, which I don't know of how many people feel comfortable doing a capital call. If they can do a capital call there and get the money, they should be fine. What I think is similar to what I was saying the last time I was on, the two things that are going to be interesting to look at are people that, when they're in a situation of distress and in the event that they default and they have to go sell, how many of those deals are coming to market where it moves the needle enough that a lot of groups across the board that are in the space that we're in can transact? Because if it's a small enough portion where it's larger groups that have a lot of capital sitting on the sideline that they need to get out the door, it's not going to do enough on pricing to really change the market, because there's a lot of people that are banking on that these maturities are going to hit. It's a lot of people are going to be forced to sell, and
all
eventually
at once,
that heightens up the cap rate to meet where a lot of people are at in terms of struggling to get debt to purchase properties. The other scenario that's going to be interesting is the people that need gap equity, that they're finding themselves short on a refinance, or there's some sort of situation there within their equity. Is the amount of equity that they can get or raise, is it enough to cover what they need, or is it a situation of we need to raise an additional 10 million to save the deal? And because we've seen on deals that we've taken a look at from a pref equity standpoint, what we can give them and still hit returns on our end is not enough to give to cover what they need. So how many of those deals are out there? Is that the majority of people that are needing pref equity? Is it not? That's going to be another thing that's interesting to see. But another thing that I don't think is getting enough intrigue is what this does to equity sources moving forward. Because when you bring in pref equity, you're hurting the returns, and you're pushing the people that are common equity further down the stack. Depending on how big you are and where your common equity sources are coming from, what does that mean? Does that mean, do some of them pull out of real estate altogether? Do they stop investing in you as a sponsor? It's going to be...
We were talking about this in so many words, like yesterday and earlier this week, is like, there are some investors that are going to be, I hate to mince words here, but screwed. And they may not know they're screwed until 2 years from now, or they may just be in a bad investment. And are these sponsors and operators that are gonna be that are running this bad investment? Are they just gonna go back out and get new investors? Like, can they just? I wonder if the investor pool is big enough where they don't care. It's like, well, yeah, this deal didn't work, but we've got plenty more where that came from.
And so I was having that conversation with Jay yesterday, where I think it's going to be dependent on how many people, and it also ties into the inflation conversation that you and I were having, where how many people are just, stuff's more expensive, I'm pissed off, versus, okay, let's look at why things are expensive. There's government spending that was done in 2021. There was a supply chain issue. There was the war in Ukraine. There's stuff with utilities have gone up. There's also, whether people want to admit it or not, a fair amount of corporate greed that went on to push it up. How many people are looking at those causes and realizing, okay, well, in some ways, there's not a lot that can be done immediately. How many people take I don't want to say a similar approach, but how many investors that are in these deals look at it and say, okay, I've invested with this group 10 times, 8, 7, 8, 9 times. The deal's gone well. This has worked. The one time it didn't, and that's because significant inflation, rose expenses. We didn't see that coming.
Yeah.
Or this the conversation you and I had Friday. Yes, we did floating rate debt. We did do a stress test, but we thought if interest rates got to 5, or we knew that if interest rates got to 5.5, we'd be in a tough spot. But we didn't think interest rates were ever going to get to. We thought they were going to get to 5.5. We thought they were going to get there 3-4 years down the line.
Especially not when rent growth's so low.
Right.
Yep.
And so what does that do to investors' mindsets, I guess, moving forward? Are there enough investors that can say at the end of the day, this is an investment. You could lose money or not get the returns we thought, but 9 times out of 10, this has worked.
Yeah. I wonder, they always say that people are more apt to leave a bad review than a good review of a restaurant or whatever. I wonder how much of, what is 9 out of 10 good enough for investors? Could be, should be, probably. But there may be a lot of people that this is their only investment and they lose a lot of money. Based on, some straight up false promises. There's several dramatic examples that we heard about earlier this fall of people that were looking for fantastic returns, and the only person that was able to tell them that they had fantastic returns was someone that may have been stretching the truth, and someone that has subsequently a company that crashed and burned since then. I'm not saying that that's happening across the market, but I am wondering what the push pull, like you said, what the push pull is from the customers of these. Essentially, the customers of these investment companies are investors, and can they afford to make them all mad? And what is going to make them mad? How it from my experience, it takes a lot to get these customers and to build that relationship where they can trust you with a great deal of money. And from my even more keener experience, if you don't take care of them and communicate with them and place them and really worry about this relationship and work hard to preserve it, then you're doing them a disservice. So I don't know if it's like in other companies, if it's like, a ship is slowly sinking, like, oh yeah, everything's okay. I don't think that's actually happening. But I would certainly be worried if I was an investor in some of these companies and I see these numbers and I'm not hearing from. I think that some of these sponsors they're not calling their investors and saying, listen, we have serious challenges that we are overcoming. I don't know if it's even a good idea to say that.
The other one
it's a mess.
The other thing I'm also thinking of is how many deals where, I guess looking at it from a 2020 to 2030 timeline, any group that is able to hold during that period, and knock on wood, that would be us from a few. Can you say on your 10-year hold, there was an odd period where from 2021 to 2023, cash flow wasn't the best, but every year after 2024, we hit expectations, or we beat them, to show people that actually there is a roadmap of hitting your return and that's the benefits of real estate. Yes, actually putting this type of debt on the property and holding it long enough. I'm curious to see how that goes. I agree. And just to quickly note, how many companies are and how kind of prominent the narrative of companies coming out to help these borrowers is this article from Institutional Investor that talks about what do they call the kind of lumbering behemoths of private credit. Specifically, they run through Apollo and Blackstone.
Apollo draws a lot of their money from insurance and annuities that fuel this non-bank lending system that they've got. Hey, you need money and banks won't give it to you. Well, I'll step in and help. Blackstone takes a little bit more from individual investors, but they are essentially they're stepping up to lend money in cases where the bank either can't lend them enough or maybe has other rules that are preventing them from funding their investment or for doing a refinance or for really continuing to operate. This is the quote here is led by alternative asset behemoths. Now, let me find the quote here so that I can highlight it. I'll just read it here. Led by alternative asset behemoths like Apollo Management and Blackstone, private credit has arguably become the most powerful transformational force in the financial world since the 2008 economic crisis. Really powerful, transformative stuff. That's what I'd say. But I really dislike these kind of shapeless images of these lumbering behemoths. Like in a much simpler way of putting it, like I think the conditions are such that regulations and the market interest rates have made it so that banks can't or won't lend out as much money as easily as before. So that's the first thing that happens. Second thing is other groups with money that don't have to follow the same rules have stepped in to lend the money. And the third thing that I'm speculating on, but I'm pretty sure is true, it's going to probably cost a little more to go with the non-banks than to go with the banks. But hey, you probably need the money, so they'll take that. Maybe they won't. Maybe non-bank lending is not going to be like the bulk of the debt that you have, but like you said, maybe it'll help bridge a gap. Maybe it'll plug a hole here so you don't have to make a capital call, or help you survive until 25. That is what's kind of interesting for me is that I don't want to get too much like rose-colored glasses about the market rising up to solve this problem, but it does seem like this solution is being created. And I said this in an earlier Gray Report episode is, for as much as the lender or for much as borrowers are needing this money, investors are looking for a chance to participate. Like if you're a multifamily investor and you haven't seen a lot of deals, which you probably haven't, then here's an option to get involved in. It's not the same as a direct investment in a deal, but to invest in some kind of non-bank lending that is lending to that has a lending arrangement with a multifamily sponsor. That may be a way of a multifamily backed investment, so to speak. It's a different vehicle. It'll probably likely have a different risk return profile, but it gets you involved in that, and it's an opportunity there that didn't exist and probably won't exist until something starts to crack in the market. But
right, yeah. I mean that definitely is the benefit of if you're on the side of pref equity and you're the one that's doling out the equity. Yeah, it's a great benefit. Because of the small opportunities and stuff that we've seen come through, It's given us a chance to potentially be involved in some markets that we otherwise would not have been.
Yeah.
And so you're kind of getting some interesting exposure to those markets, those opportunities, but there's also some assurance of aside from your debt, we get paid first. So,
yeah. I do like. I'm wondering if there is some kind of counter reaction. Like the way that article was framed was also talking about. This was the Institutional Investor article. Yeah. So the way that article is framed there, it almost sets up this oppositional relationship between banks and non-bank lenders. It's assuming that they are kind of enemies, but in the headline they call them frenemies because as we've noticed too, you can probably talk to some banks and the banks are like, yeah, actually, we got a list of some multifamily people that you can help. And they may have like, for example, they may have an apartment lender that they have lent, or I'm sorry, an apartment borrower that they have lent as much as they can. And they're like, listen, we just need you to step in here and finish out, finish out, give them the rest of the equity, and we can all be happy.
Well, there's two things I noted in reading. I'm hoping I'm getting the story and the quote correctly. I want to say Jamie Dimon had mentioned that when you cut back on these services, there's a lot of things that banks are able to offer do that with these regulations be a lot of services that are cut.
Yeah.
And if I'm not mistaken, someone kind of shot back at him from the private lender space that kind of said like, yeah, but looking at your profits, like your business is doing fine. Like,
yeah,
oh no, you can't participate in this one segment that you do.
Yeah.
How bad is it really? So I thought that was interesting, but if there's enough deals where they're going to need to refinance, there's a gap in between where they wanted to be and where they're shaking out on debt proceeds, then they're going to have to, if they can't get that equity to come in and keep things moving along, then there's a massive risk of, okay, they're going to have to go to the market. And it's not going to be a situation of, well, okay, let's see what we can get. Maybe we'll sell. If things aren't looking as well as we want them to, we can always go back and refinance. If they're in a situation where they have to go to market, whatever the highest price is, or whatever the highest price from someone that's reliable to close is, they're going to have to sell to.
Yep.
If that happens enough across the board and enough of them somehow manage to sell for an amount that is they're going to be short in terms of what they owe to the lenders, there's going to be some major issues that I'm sure the lenders are thinking, yeah, if that's the scenario that we're facing across the board, we would really love it if someone came in, provided that extra capital, just so that hopefully if they can get by another 2 or 3 years where we're all assuming that the market's going to be better, that's a lot better off. Because I have talked with a fair amount of brokers where they've talked with groups where, hey, we're in an interesting debt situation, and by interesting, I mean like they're really screwed and they need a lot of help. Can you underwrite the deal? And brokers are underwriting, telling them what the value is, and those owners are coming back and saying, the value that you're saying my property at is what my loan is. Get that BOV up. And so if that, assuming that is widespread, I don't think that's anything that's just local here or just local up in Chicago or whatever. I think it's across the board. There's very much.
I wonder. It just does seem like there is a subtext of the article where banks may be threatened by these non-bank lenders. Like, you don't want to give too much market share to them, but I still can't imagine a situation where non-bank lenders will be someone's primary source of debt. So if we maybe get to that point, then there's going to be some regulation, I'm sure.
And this is way beyond my pay grade, way beyond my understanding. There was a lot of business practice and stuff that was going on during the financial crisis where obviously through the bailout, the government determined that, hey, a bunch of these banks going under, a bunch of these banks failing is not ideal. It's going to crash money markets. It's going to crash a lot of things. I don't know if that sentiment's going to be there if, hey,
these non-bank lenders,
Blackstone's really screwed, or hey, Apollo's done for. I don't. I mean, I'm sure there's going to be a ripple effect.
But they don't have the projections.
So
no, I think that's a good point. I just have to move on here, but
I mean, what I read from that Jamie Dimon quote was very much that it seems like the banks are pissed off that they can't be a part of.
And some of them are forming, I agree. Some of them are forming their own arms for like private lending and stuff like that. There was a subtext in that article that was mainly like, there's probably more of an antagonistic relationship than would be implied by, the guy from Blackstone be like, oh yeah, it's a win-win-win. Everyone wins. Like, no, I don't. I think that banks probably are going to want to reclaim some of the territory that they lost in the future, but that's just my own. All right, I want to run through these really quickly. So coming up here, there are three very, very emphasis on quick reviews of the multifamily market and rent growth and what's happening in apartments right now. RealPage, we'll start with their account, and they're talking about how apartment rents have remained flat year over year and show signs of leveling off, in parentheses, for now. So there's always room for doom and gloom, I guess. It does seem like it is not going to dip into the negative for year-over-year rent growth as RealPage measures it here. So their rent growth was 0.08% in October year-over-year, and then in November it was 0.16%, so slightly improving. Not, we're talking about thousandths of a percent, but still, or was that hundredths of a percent? Well, yeah, whatever. Very small amounts of an increase, but I think it's meaningful that it's not in the negative, because if we go, or now this is, I'll just round out this RealPage story here. It is talking about, it's very much a supply story. Rents are falling in the West and South where there was a lot of supply. And importantly, as we have noted earlier in this show, wages continue to outpace rents. And they say November should almost certainly mark the 12th consecutive month where wage increases outpace rent increases, a trend that'll likely persist through next year. That could erase all of the rent over wage bump of 2021 and early 2022, and in turn help further widen the demand funnel. Rent is too damn high. We were hearing that before the pandemic. And we have mentioned how persistent inflation, inflation anchors are. We want that price, that we are hoping rents go back to like they were in 2019, et cetera, et cetera. It is a big story that wages have outpaced rents for so long. And if it continues to, I don't see, I think it is a recipe for increasing rents. But that's going to depend upon supply a little bit. But man, it is a huge factor.
From what they're saying, actually, can you scroll up just
yeah?
Because it looks like they said rents are falling everywhere.
Rents are falling everywhere. Among the top 150 metros, 41 included rent growth of more than 3%. Most of these markets are located in the Midwest and Northeast regions. And among large markets, Chicago led the way at 3.6, followed by Northern New York, Cincinnati, Milwaukee, Cleveland, Boston, Indianapolis, and St. Louis. A lot of Northeast and Midwest ones.
Well, okay. So Indianapolis is in that list. Mm-hmm. Personally, that's a bit of a bummer. But
yeah, sorry.
What was interesting in reading this was they said not only do they see the wage growth over rent growth,
mm-hmm.
not only do they see that going into next year, but it sounded like they weren't very bullish on rent growth in 2024 either.
Yeah.
And that was interesting because it seems like initially when I read it, they're like, well, leasing activity isn't really too high right now in October, November, December, and headed into the winter months, which it never is.
Yeah. Yeah.
But to hear them say like, end of 2024, hopefully things pick up. But
yeah.
But I mean, by no means were they sounding the alarm of we're going to be experiencing massive negative rent growth. It was interesting to hear them kind of sound that alarm of like, 2024 is going to be kind of a letdown.
And the same thing, and a very similar message was conveyed by this apartment list, which has a series of 7 predictions for the 2024 rental market. Cooling rent. What I think it was this one. They said low single digits for rent growth. Well, one of these reports, either RealPage or Apartment List, has said expect low single digits for rent growth next year. That may be true, but low single digits is where rent growth normally is. So if we get 3 to 4% rent growth, that's the lower of the single digits, and that would be pretty typical for a non.
I am wondering if similar to what you had mentioned I shouldn't say similar, when you would use the situation of people like better buy those damn potato chips now because it's going to get more expensive when you come back next week.
Yeah.
Wondering if there's also something going on with renters of their renewing because they're worried about things going up a ton.
Yeah.
Or if it's a standpoint of, I don't really care about the amenities anymore. Like people now have put some stuff into perspective of, I don't know what's going to happen in 2024. Mm-hmm. So the nicest but cheapest place I can live is what I'm going to do.
Yeah. Yeah.
If that's enough to That's what's going on.
Yeah, I agree. I think that it will remain to be seen what renters are going to do. One of the pressures I think that Apartment List does talk about in this seven these seven reasons or seven predictions for the market is that the changing rent versus buying math will create more long-term renters. It's so expensive to buy a home that maybe people are, I'll renew this apartment rather than making the plunge and buying a home. That's really apparent, and that's going to be really hard to remove as a factor. Like, home prices are going to have to go down significantly for that math to make sense anymore. Mm-hmm. It's just really kind of crazy. Now, I know I'm flying through this. I didn't get through all 7 reasons, but you can find that article in the Gray Report newsletter. If you have already subscribed to the Gray Report newsletter. If you haven't subscribed to the Gray Report newsletter, you can go to graycapitalllc.com/newsletter and subscribe to our free weekly newsletter with all of the information, data, research, reports, little bit of commentary, not a whole lot of commentary. I get straight to the point. Lots of great points, less fluff. Every Thursday, free, great, perfect, awesome. On we go. All right, let's go. Let's go to the Yardi Matrix article covering similar material as the Real Page and Apartment List. Another overview of the national multifamily market. I just want to come up with some top line numbers now. Apartment List was I didn't note this in their article, but they did record a negative 1.1% rent growth for the year, and it's definitely lower than Real Page and Yardi Matrix. Yardi Matrix has positive 0.4%, so still not that much higher than zero, but we're all hovering around zero. It's probably going to be flat for the year on average. Notable too, it shares a lot of the same markets for rent growth leaders, so they're all converging on a similar set of markets really in the Northeast and Midwest. They're talking about you got your New York cities, your Kansas cities, your New Jerseys, Columbus, Chicago, Boston, Indianapolis. Not a Sun Belt in sight in this top 5. Let's see, 1, 2, 3, 4, 5, 6, 7, 8. Ooh, you got to go to number 9 for San Diego before you start seeing some kind of Sun Belt markets in there. But still, the former high flyers are a little bit more subdued, but still, not out of it completely. When we're talking about short-term changes, rent growth was highest in Kansas City and New York. And when talking about lifestyle asset classes, Indianapolis had some significant month-over-month rent growth, but some serious declines. I'm talking about like almost 1.5% decline in 1 month of rents in Raleigh, a full 1% in Seattle, Orlando, Las Vegas, Charlotte, Austin. All of those rents went down by 1% in 1 month. This is a winter month. This is seasonality, and I'm sure that is a result of huge amounts of supply. But it's gonna get a little bit more bumpy, and only gradually improve as we get into early 2024.
Right.
Like we've said, I think that we've painted a pretty good picture of where the market's moving in general, and a pretty, I think, a pretty stirring conversation of what you might expect in the economy, in the lending market, and in the multifamily market. Any kind of closing words that you had, Addison? Addison, I have delayed an extensive conversation about the use of artificial intelligence in the multifamily industry. I don't think we have time to talk about that. I don't know if you're still interested. And maybe 45.
I wasn't interested to begin with, quite frankly. So,
I did promise that last week that we would have a discussion, and I will put that on hold. But I've got a lot. I have teed up with several articles, really dealing with my dissatisfaction of the term AI as this kind of catch-all word. For you could just use the word computer to say everything that AI says, and so I'm looking for a little more specificity there. I think that there are lots of great tools, but I think we need a new word for it, because one person's AI is another person's automatic email. Yeah, exactly. Yeah.
No, this is, you and I were talking about this earlier, and I may or may not be using one of my parents as an example here, but I remember when it was like 2012, 2013, when the whole like selfie term became the thing. And a fair amount of people just started calling everything selfies. And I may have not have had a parent that was like, if you take a selfie of me next to this thing, and it was like, no, it's a picture is what's happening.
Yeah.
That's very much what I feel when people just throw out AI. It's like, running a formula in Excel is not AI. This was around in 2009. This was around in 2003.
Yeah. I completely agree. I think that I trust the companies that, they may mention AI, but they're more focused on like what they're doing with it. That's all I want to know. What kind of stuff? Like, if you're telling me, if you're making a decision and crunching numbers in ways that I don't even understand, that to me is more AI than like, okay, when X happens, I want you to do this automatically. There's nothing intelligent about that. That's just a switch. So I'm going to dig into that a little bit more with some great examples of useful uses of AI, I think, and ones that are like, all right, this is just Chat GPT with another coat of paint on it.
And I very much get a kick out of the whole like, it's all this AI stuff. You're not even going to be driving cars in 3 years.
Yeah.
Well, no one moves that fast.
Yeah, it's been a year. I did. Because it's like the year anniversary of ChatGPT, the kickoff of this like kind of whole conversation, even though it was around before then, obviously we just said that. But it is interesting in how little it's changed. Like people were freaking out. You were making fun of me for freaking out about AI last year, a year from this week or whatever. It sparked a lot of people's imagination. And I think it is being used a lot. I'm sure it's there's all these articles about how it's generating like half of the garbage copy text on any website now. And like, it's great for filler text. But like, I haven't really seen like, whoa, like this is doing something I couldn't even imagine it doing, or me being able to do that. I'm super interested in its ability to take a bunch of data and filter it for me, give me an answer, but I don't see that yet. I haven't seen enough case studies that there were.
So hold on. Yes. So what you're saying is what you thought was going to happen last year has not happened.
Not like I wanted it, or not like I was hoping or fearing.
Okay, so for those of you that are listening, if you hear a rumbling, especially in your car, that's Matt fighting the urge to say Addison was right.
Well, let's just say there are shades of rightness. All right. Yeah, that's good. I think we can end there. Addison, it was my mistake for disagreeing with you, and I'll put that on the record. I am adapting, but I don't think the AI is like out of the picture. I still think it's worth tracking and obviously like learning to use it. But I also get a huge kick out of the AI experts, the people that weren't really talking about it at all, but all of a sudden a year goes by and they have some kind of PhD in something that didn't even exist 12 months from now, or from a month ago. Yeah. So I don't get, I don't get that. Like, there's courses taught by people that, that may or may not be, it may just be chatbot, chatbot prompts. This is a whole course on it. Now, again, it's a tool that you should be able to use, but we are at such a weird point where AI can mean so many things for so many different people. And sometimes I feel like it means like, oh yeah, it's the same thing you're getting. It's just a little more expensive because we know you'll pay more for AI.
It's always funny seeing the AI experts or whatever, and you see their like profiles or just how their LinkedIn pages are designed.
Oh, it's a hype cycle, and there's a lot of hype men out there. Yeah. I want a real boring use case for AI that it lacks the flash and substance, but it means a whole lot when it comes to how much money it can bring in people. Like, what about a factory determining
who to lay off,
determining who to lay off or what to keep in their inventory, or based on a bunch, like I said, a bunch of criteria that they don't even know about. Like when the weather's bad, you want to buy more of this specific part because the trucks don't come in as quickly. Some correlations that we aren't thinking about, that by processing that amount of data, they're able to come to. to, but I haven't found, like, everyone said, like, yeah, I try to get it to read my emails, and like Google was just pushing out, like, in a beta, some kind of like email AI thing where it combs through your emails and it can answer questions or draft an email based on your previous email history, and it wasn't so great at doing that. It was confusing sendings and recipients. Like, it is still, like I said, it's conceptually great, theoretically amazing, but we're not there yet. I feel disappointed.
As much as I joke about AI telling companies who to get rid of, that's probably what it will be used for.
Oh,
like everyone's going to all the positive outcomes and everything that's going to
blame. And just to put a cap on a discussion that I probably have way too much. I think so much about AI is going to about its implementation and the legal framework is going to be like, who is responsible for what an AI decision that gets made, whether it is like a byline of an article, so if something's wrong about that article, then you better attach it to a real person so they can be responsible, or like if an AI makes a decision for a company that costs a company millions of dollars, are you going to blame the AI service, or are you going to blame the person in that company that implemented that AI solution? There's a whole lot of things when you're I think that keep the human in the loop. It's easy. That's easier said than done. I think that the worry is that people keeping the human in the loop is just going to be someone saying like, yep, I agree with AI. I agree with AI. I agree with AI. And they're not making their own decisions. They're just taking the easy road out, which is, well, I think what we all would do. It's human nature. So that's going to be interesting.
Starts as a cause, morphs into a business, ends up a racket.
That's right. Yeah. So I think that so much could hinge on responsibility and it just connected to a real person. Because if not, then everyone gets the easy way out. And I think that makes a lot of things harder. Around. All right, that's all I got. Thanks, and stay tuned. Well, we can keep talking, but I think I'm getting a little less comfortable with in this room here with you. So I'll see you next time. Spencer will be back, and again, please remember to subscribe, follow, whatever the terminology is. Keep track of us.
Leave a 5-star review on Apple Podcasts.
Or comment if you disagree, or if you do agree. We want that engagement, and we value your opinion.
You said you'd read the reviews on air as long as it's a 5-star.
Yeah, that's right. I will. Thanks.